Hey everyone, I'm Elizabeth Schulze, and our top story at this hour is the Federal Reserve announcing that it's leaving interest rates unchanged and forecasting 3 rate cuts next year. The Fed's decision comes at the end of its 2-day policy meeting and just 1 day after the latest inflation reading showed price increases slowing down across the U.S. economy. Our Alexis Christoforous joins us now for more. Alexis, the Fed leaving its main rate unchanged here, but announcing that it could cut rates, at least forecasting that it could cut rates 3 times next year. How big of a change in policy is this?
Well, this is an early Christmas present, Elizabeth, for both investors and consumers. The reaction in the stock market was swift. The Dow up about 300 points, now looking at a record close following the Fed's decision. The decision itself to leave interest rates unchanged was largely expected. It's the 3rd time the Fed has done that now for the 3rd straight meeting. What was not expected necessarily was the Fed's interest rate cuts that it's now forecasting for 2024. Initially, months ago, the Fed had signaled it might cut rates maybe once or twice next year. It is now forecasting 3 interest rate cuts in 2024. And we know that's going to mean lower borrowing costs for Americans in the form of lower interest on their credit cards, home equity loans, auto loans, and even mortgage rates, which, by the way, in anticipation of what the Fed did today, mortgage rates have also been coming down for the past 6 weeks. And just a short time ago, Fed Chair Jerome Powell really gave his strongest signal yet that the Fed may be done hiking interest rates for now.
While we believe that our policy rate is likely at or near its peak for this tightening cycle, the economy has surprised forecasters in many ways since the pandemic, and ongoing progress toward our 2% inflation objective is not assured. We are prepared to tighten policy further if appropriate.
Now, the Fed is not declaring victory in its fight against inflation, but it did acknowledge today that inflation has, quote, eased over the past year. In fact, the Fed now lowering its inflation projection for next year to 2.4%. That is down from 2.6%. And Elizabeth, we know this week we found out inflation now sits at 3.1%. So we're getting there, albeit very slowly.
We're getting there. And talk a bit about this decision by the Fed. What will this mean if it does go through with those rate cuts? We've already seen, as you mentioned, mortgage rates lower. Is that additional relief then for borrowers as we head into next year, Alexis?
Well, if they do indeed cut rates next year, it would be the first rate cut we've seen from the Fed since March of 2020 at the beginning of the pandemic. At that time, the Fed was looking to light a fire under the economy and to encourage people to get out and spend. And what this would mean is that, yes, it would make borrowing costs cheaper. But, you know, ironically, Elizabeth, it may mean that in the short term, the economy slows down even more dramatically. Why? Because consumers may think, well, look, the Fed is projecting interest rate cuts later in the year. I may just hold off on getting that loan, making that big purchase until those rates come down. So ironically, we may actually see the economy slow down further as we move closer to those interest rate cuts next year.
And for housing, many buyers who've been on the sidelines waiting for those rate cuts. But if everyone gets it at once, could prices go up? Alexis, you mentioned the stock market is surging. Talk a bit about why this would be such positive news for the markets and how we've seen a pretty good run here for stocks in recent weeks.
We really have. I mean, it's been a record close for the S&P 500 and the NASDAQ recently. Now the Dow is looking to join the party with its own record close. So it seems like we're going to end the year with what they call a Santa Claus rally, right? Because Wall Street wants to see it get cheaper to borrow money, not just for consumers, but for businesses and business investment. It means that inflation is moving in the right direction. The economy is slowing, but not so much that we're falling into a recession. You and I have talked a lot about the Fed's soft landing, that it can lower inflation without pushing the economy into a recession. With today's decision and the Fed's now forecast for rate cuts, it looks like the Fed firmly believes that soft landing is in sight.
A good case scenario. Alexis Christoforous, always a joy to talk about the economy with you. Thank you.
Same here. Thanks.
Hi, everyone. George Stephanopoulos here. Thanks for checking out the ABC News YouTube channel. If you'd like to get more videos, show highlights, and watch live event coverage, click on the right over here to subscribe to our channel. And don't forget to download the ABC News app for breaking news alerts. Thanks for watching.